Hello and welcome. Today we're diving deep into one of the most explosive sectors in technology and investing right now, artificial intelligence or AI. You've seen the headlines, you've heard the buzz. AI isn't just coming, it's here, and it's reshaping industries from healthcare and finance to entertainment and transportation. The big question on every investor's mind is, how can I get exposure to this revolution? Which companies are leading the charge? And which artificial intelligence stocks are potentially set to explode? In this video, titled The Best Artificial Intelligence Stocks Set to Explode, we'll analyze the top contenders in the AI space, looking ahead towards 2025 and beyond. We'll cut through the hype and look at the fundamentals, the technology, and the potential growth drivers for key players. We'll also explore a fascinating example of AI's future application. A hypothetical startup using AI to revolutionize personal fashion, offering curated outfits, virtual try-ons, and sustainable choices. This will give us a glimpse into the kind of innovation fueling the AI boom. Before we begin, a quick disclaimer. I am an AI, and this information is for education purposes only. It is not financial advice. Investing involves risks, and you should always conduct your own research and consult with a qualified financial advisor before making any investment decisions. All data points and market information mentioned are based on information available up to today, April 20th, 2025, and market conditions can change rapidly. Now let's jump into the AI revolution. So, what exactly is artificial intelligence, and why is it suddenly everywhere? At its core, AI refers to computer systems designed to perform tasks that typically require human intelligence. This includes things like learning from data, recognizing patterns, understanding language, making decisions, and solving problems. While the concept of AI has been around for decades, we're experiencing a boom right now due to a convergence of factors. Firstly, the explosion of data. We generate unimaginable amounts of data every day, and AI algorithms need vast datasets to learn and improve. Secondly, massive advancements in computing power, particularly with specialized hardware like GPUs, graphics processing units, and TPUs, tensor processing units, allow us to train complex AI models much faster than ever before. And thirdly, breakthroughs in AI algorithms, especially in areas like deep learning and generative AI. The technology behind tools like ChatGPT and image generators have unlocked incredible new capabilities. The impact is far-reaching. In healthcare, AI is helping diagnose diseases earlier and discover new drugs. In finance, it's powering automated trading and fraud detection. Autonomous vehicles rely heavily on AI for navigation and safety. E-commerce uses AI for personalized recommendations and optimizing. Logistics. Even creative industries are using AI for content generation. This widespread adoption is driving enormous investment. Companies are pouring billions into AI research, development, and infrastructure. Market forecasts predict the global AI market will reach trillions of dollars within the next decade. Some analysts even suggest the AI sector could be worth over $2.5 trillion by 2033. This isn't just incremental change. It's a fundamental technological shift, often compared to the dawn of the internet or the mobile revolution. And just like those earlier shifts, it presents potentially massive opportunities for investors. But identifying the winners in this rapidly evolving landscape can be challenging. So, how do we sift through the noise and find the AI stocks with the most potential? Investing in AI isn't just about finding companies using AI. It's about finding companies that are enabling the AI revolution or have integrated AI so deeply into their core business that it creates a significant competitive advantage. Here are some key criteria to consider when evaluating potential AI stock investments. First, market leadership and technology. Is the company a leader in a specific AI niche? This could be hardware like AI chips, software platforms, cloud AI services, or specific AI applications. Look for companies with unique defensible technology and a strong track record of innovation. Second, financial health and growth. Strong revenue growth is crucial, especially from AI-related segments. Look at profitability margins and the company's ability to invest heavily in research and development (R&D) to stay ahead. Third, strategic partnerships and ecosystem. AI doesn't exist in a vacuum. Companies that forge strong partnerships, like cloud providers working with AI model developers or hardware makers supplying key components, often benefit from network effects and a wider reach. Consider the strength of the company's ecosystem: developers, customers, and partners. Fourth, management and vision. Does the company have strong leadership with a clear vision for how AI will drive future growth? Look for management teams that understand the technological landscape and can execute effectively. Metrics like price to earnings (PE), price to sales (PIS), or price earnings to growth (PEG) ratios, relative to growth expectations and industry peers. Be wary of excessive hype. Sixth, total addressable market (TAM). How large is the market the company is targeting? With its AI solutions, a large and growing TAM provides more runway for long-term growth. Keeping these factors in mind, let's move on to analyzing some of the specific companies that are frequently cited as top AI stock contenders for 2025. Alright, let's kick off our deep dives with arguably the most prominent name in the AI hardware space, NVIDIA, ticker symbol NVDA. NVIDIA started as a graphics card company primarily for gaming, but its powerful GPU turned out to be perfectly suited for the parallel processing required to train large AI models. Today, NVIDIA absolutely dominates the market for AI chips, particularly in data centers, holding an estimated market share well over 80%. Their key advantage isn't just the hardware itself, but also their proprietary software platform, CUDA Compute Unified Device Architecture. CUDA allows developers to easily program NVIDIA's GPU for various AI and high-performance computing tasks. This creates a significant software moat, making it difficult for competitors to displace them quickly. NVIDIA's financial performance has been staggering, driven by the insatiable demand for AI chips. From cloud providers and enterprises building out their AI infrastructure, the company saw its revenue and profits skyrocket over the past couple of years, with its market capitalization soaring past the $2.5 and even $3 trillion mark at times. Their data center segment is the primary growth engine, generating tens of billions per quarter. Looking ahead, NVIDIA isn't resting on its laurels. At recent events like CES and their GTC 2025 conference, CEO Jensen Huang outlined the shift towards what he calls physical AI. AI that can perceive, reason, plan, and act in the physical world. This involves robotics, autonomous vehicles, and advanced simulation capabilities powered by platforms like NVIDIA Omniverse and the new Cosmos platform for training physical AI systems. They are also constantly pushing the hardware envelope. The current generation Blackwell architecture is being deployed, and the next generation Rubin architecture, Project Digits, a compact AI supercomputer, aimed to make AI more accessible. However, investing in NVIDIA isn't without risks. Firstly, its valuation is high. While recent market volatility might have brought it down from peaks, it still trades at a premium, reflecting high growth expectations. Any slowdown in AI spending or failure to meet these expectations could hit the stock hard. Secondly, competition is intensifying. AMD is making strides, and major cloud providers like Google, Amazon, and Microsoft are developing their own custom AI chips, potentially reducing their reliance on NVIDIA over the long term. Thirdly, geopolitical risks, particularly surrounding semiconductor manufacturing, and potential trade restrictions or tariffs, especially involving China and Taiwan, where TSMC, NVIDIA's primary manufacturing partner, is based, remain a concern. Finally, the sustainability of the current breakneck pace of AI infrastructure spending is debated. Some analysts worry about potential excess compute capacity being built, which could lead to a slowdown in hyperscaler capital expenditures. Despite these risks, NVIDIA remains the undisputed leader in the AI chip market for now. As long as the AI build-out continues, NVIDIA is positioned to be a primary beneficiary. Its strong technological lead, sticky software ecosystem, and clear vision for the future make it a core holding for many AI investors. Next up, we have Microsoft, ticker symbol MSFT. While NVIDIA powers the hardware, Microsoft is arguably leading the charge in integrating AI into software, services, and the cloud. Microsoft's AI strategy revolves heavily around its Azure cloud platform and its multi-billion-dollar strategic partnership with OpenAI, the creator of ChatGPT. Through Azure OpenAI service, Microsoft offers businesses access to powerful large language models like GPT-4, GPT-4o, and others, along with enterprise-grade security and compliance features. Microsoft is continually updating these services, retiring older models and introducing newer, more capable versions, including multimodal models that can understand images and vision. Recent updates to Azure AI services include enhanced agent capabilities, allowing developers to build more sophisticated AI assistants using tools like Microsoft Fabric for data interaction, and even bring your own bio-storage options for better data control. Beyond the cloud, Microsoft is aggressively embedding AI across its entire product portfolio. Through its Copilot initiative, Copilot acts as an AI assistant within Windows, Microsoft 365, Office apps like Word, Excel, PowerPoint, Teams, its Edge browser, Bing Search, and even developer tools like GitHub. The goal is to enhance productivity and creativity for millions of users. This integration strategy is key. By bringing AI directly into the workflow of its massive existing user base, Microsoft aims to create sticky ecosystems and new revenue streams, particularly through enterprise subscriptions for Copilot features. Financially, Microsoft is a behemoth with strong, diversified revenue streams across cloud, software, Windows, Office, gaming, Xbox, and more. Azure remains a significant growth driver, consistently battling Amazon Web Services for cloud market leadership. The contribution of AI services to Azure's growth is becoming increasingly important and closely watched by investors. Like Alphabet, Microsoft has also announced massive investments in AI infrastructure, planning to spend tens of billions to build out the data centers needed to power its AI ambitions. What are the risks for Microsoft? Competition is fierce, particularly from Google and Amazon in the cloud AI space. The successful monetization of Copilot features at scale is still developing and demonstrating a clear return on investment for enterprise customers will be crucial. Its close relationship with OpenAI, while currently a strength, also carries risks related to OpenAI's own governance, strategy, or potential future competitive moves. Regulatory scrutiny is also a constant factor for big tech companies, particularly around AI's potential impact on jobs, privacy, bias, and market concentration. Overall, Microsoft's deep integration of AI across its vast software and cloud ecosystem, its strategic partnership with OpenAI, and its strong enterprise relationships position it as a key player in the AI revolution, particularly in bringing AI tools to businesses and consumers worldwide. Our third major contender is Alphabet, the parent company of Google, ticker symbols GOOGL and GOOG. Google has been a pioneer in AI research for over 2 decades, leveraging it extensively in its core search engine, YouTube, digital advertising, and Android mobile operating system. Alphabet's AI efforts are broad and deep. They have their own world-class AI research labs, including Google AI and DeepMind, which are responsible for breakthroughs like AlphaFold in protein folding and developing their flagship large language model family Gemini models, including the recently announced Gemini 2.0 and 2.5 Flash, are designed to be multimodal, understanding text, images, audio, video, and are being integrated across Google products, from powering AI overviews in search results to enhancing features in Google Workspace and Android. Like NVIDIA, Google also develops its own custom AI chips called Tensor Processing Units, or TPUs. They recently announced their 7th-generation TPUs, codenamed Ironwood, promising significant performance and efficiency gains for training and running their AI models. These TPUs power Google's internal services and are also available to customers via Google Cloud Platform GCP. GCP is Google's answer to EOS and Azure, offering a suite of cloud computing services, including various AI and machine learning tools, powered by technologies like Gemini and TPU. They also recently made their extensive global private network available to enterprises as Cloud One, aiming to offer performance advantages for cloud customers. Alphabet is also investing heavily in other AI-driven areas through its other bets segment, most notably Waymo, its autonomous vehicle technology company, which is considered one of the leaders in the self-driving space, operating ride-hailing services in several U.S. cities. Earlier this year, Alphabet announced a massive $75 billion capital expenditure plan for 2025, largely earmarked for AI infrastructure expansion, signaling its commitment to compete aggressively in the AI arms race. However, this massive spending plan initially spooked some investors, contributing to concerns about the return on investment from AI and potentially slowing growth in its Google Cloud segment compared to rivals. The risks for Alphabet include intense competition from Microsoft and AWS and from various players in the AI model space, including OpenAI and startups like Anthropic. Successfully monetizing its AI advancements beyond its core advertising business, which itself faces challenges and scrutiny, remains a key focus. While AI overviews in search might drive engagement, their long-term impact on ad revenue is still being assessed. Regulatory pressure is a significant overhang for Alphabet, with ongoing antitrust investigations and concerns about its market dominance in search and digital advertising. Potential regulations specific to AI could also impact its business model or deployment strategies. Despite these challenges, Alphabet's deep roots in AI research, its vast data resources, its powerful infrastructure, including custom TPUs, and its integration of AI into globally dominant products make it a formidable player. Its investments in areas like Waymo also offer significant long-term potential. While NVIDIA dominates the AI chip market, its primary competitor is Advanced Micro Devices, or AMD, ticker symbol AMD, traditionally known as a rival to Intel in the CPU central processing unit market. AMD has increasingly focused on the lucrative data center and AI accelerator space. AMD offers both high-performance CPUs like its EPYC line for servers and GPUs under its Instinct brand designed for AI workloads and data centers. Their strategy is to offer compelling alternatives to NVIDIA's products, often competing on performance per dollar or specific features. The company has seen significant success in its data center segment, with revenue growing rapidly, driven by adoption of its EPYC CPU and increasing traction for its AI accelerators. AMD's Instinct MI300 series, particularly the MI300X GPUs, being positioned as a direct competitor to NVIDIA's high-end offerings and has secured wins with major cloud providers like Oracle Cloud and other infrastructure players. AMD projected generating around $5 billion from AI accelerator sales in 2024, a significant number, though still dwarfed by NVIDIA's data center revenues. Looking ahead to 2025, AMD is continuing its product cadence. The M325X, an update to the MI300 architecture, is becoming available. More significantly, the next generation Instinct MI350 family, based on a new architecture, is expected later in 2025, promising substantial performance improvements, particularly in AI inference running trained models. The MI400 family is slated for 2026. Analyst expectations for AMD's AI chip revenue in 2025 vary. Some forecasts suggest it could reach $7 billion to $10 billion, representing strong continued growth. However, other analysts express caution, citing potential headwinds. The biggest challenge for AMD remains NVIDIA's dominant CUDA software ecosystem. While AMD supports open-source alternatives like ROCm, CUDA is deeply entrenched, making it the path of least resistance for many developers and organizations. building AI applications. Overcoming this software barrier takes time and significant investment in developer tools and community support. Another risk is the trend of major cloud providers, hyperscalers, developing their own custom silicon like Google's TPUs, Amazon's Trainium Inferentia, Microsoft's Maya. While these hyperscalers are still major customers for NVIDIA and AMD, increasing reliance on in-house chips could potentially dampen demand for third-party accelerators over time. Supply chain constraints could also impact AMD's ability to ramp up production quickly enough to meet demand, especially as it competes for advanced manufacturing capacity at fabs like TSMC alongside NVIDIA. Furthermore, some analysts worry that AMD's AI chip sales growth might disappoint lofty market expectations in 2025, potentially leading to stock volatility if quarterly results don't show continued acceleration. In summary, AMD is the clear number 2 player challenging NVIDIA in the AI accelerator market. It has strong products and is gaining traction, offering significant growth potential if it can continue to execute well and chip away at NVIDIA's dominance. However, it faces substantial hurdles related to software, competition from both NVIDIA and in-house chips, and high market expectations. Moving from hardware and cloud giants, let's look at Palantir Technologies, ticker symbol PLTR. Palantir is a software company specializing in big data analytics and AI platforms. Initially known for its work with government agencies, particularly in defense and intelligence. Its core platforms, Gotham for government and Foundry for commercial enterprises, help organizations integrate vast disparate datasets and use AI to find patterns, make predictions, and inform decision-making. Palantir's recent surge in relevance and stock price has been heavily driven by the launch and rapid adoption of its artificial intelligence platform, or APE. APE allows customers to build, deploy, and manage AI models, including large language models, securely on top of their own private data within the Palantir ecosystem. It enables the creation of AI agents that can automate tasks and integrate AI directly into operational workflows. The introduction of APE has significantly accelerated Palantir's growth, particularly in the commercial sector, attracting new customers and expanding deals with existing ones. The company has reported multiple consecutive quarters of accelerating commercial revenue growth. Since APE launch, Palantir also emphasizes AI capabilities, allowing its platforms and AI models to run in environments with limited or no connectivity, such as factories, vehicles, or remote locations. Financially, Palantir has shown impressive growth and achieved GOP profitability. Its stock price saw a phenomenal run-up, increasing several 100% since early 2024, fueled by the AI hype and strong results driven by APE. For 2025, Palantir has provided an ambitious forecast targeting revenue of around $3.75 billion, representing over 30% growth, and adjusted operating income exceeding $1.05 billion, figures that notably surpassed analyst consensus at the time. The primary risk associated with Palantir is its valuation. After its massive stock run, it trades at very high multiples of sales and earnings. This valuation price is insignificant future growth, making the stock vulnerable to corrections if the company fails to meet these ambitious growth expectations consistently. Maintaining a 30–40% growth rate year after year is challenging, especially as the company scales. Competition is also a factor. While Palantir offers sophisticated end-to-end platforms, it competes with various players in the data analytics and AI space, including cloud providers, native tools, other specialized AI software companies like C3.ai or Databricks Private, and potentially large system integrators. Historically, Palantir faced concerns about its reliance on large, lumpy government contracts. While its commercial business is growing rapidly thanks to APE, continued expansion and diversification remain important for long-term stability. Despite the valuation concerns, Palantir's APE platform appears to be resonating strongly with customers seeking to deploy operational AI within their organizations. Its ability to integrate data and AI for complex decision-making in both government and commercial sectors positions it as a unique player in the enterprise AI landscape, often referred to as a potential secret AI champion. Beyond these key players, several other companies are significantly involved in the AI ecosystem. Amazon. As the leader in cloud computing with Amazon Web Services AIs, Amazon offers a vast array of AI and machine learning services, including its own custom chips, Trainium and Inferentia, and platforms like Bedrock for accessing various foundation models. AI is also deeply integrated into its e-commerce operations, recommendations, logistics, and devices. Alexa. Meta Platforms. Meta, the parent company of Facebook, Instagram, and WhatsApp, invests heavily in AI research and uses AI extensively for content recommendation, ad targeting, and powering its metaverse ambitions. They also release open-source AI models like Llama, contributing to the broader AI ecosystem. C3.ai. This company focuses specifically on providing an enterprise AI platform and pre-built AI applications for various industries like oil and gas, manufacturing, and utilities. They emphasize their C3 agentic AI platform and partner with companies like Microsoft and PwC. C3.ai has been recognized for its growth, though like Palantir, it often faces scrutiny, overvaluation, and customer concentration. Taiwan semiconductor manufacturing company TSM. While not designing AI chips, TSMC is the world's largest contract chip manufacturer and produces the cutting-edge chips for companies like NVIDIA, AMD, Apple, and many others. As the demand for AI chips booms, TSMC is a critical enabler and beneficiary, albeit indirectly. There are also numerous smaller or more specialized AI companies, but these giants currently dominate the investment landscape due to their scale, resources, and integration of AI across vast ecosystems. Now that we've looked at the major players providing the building blocks and platforms for AI, let's shift gears and explore a specific, innovative application of AI that highlights where this technology is heading. Imagine a startup aiming to solve some common frustrations in the fashion industry. The difficulty of finding clothes that fit well and match personal style online, the high rate of returns due to poor fit or unmet expectations, and the growing desire for more sustainable fashion choices. This hypothetical startup uses AI as its core engine to create a hyper-personalized and sustainable fashion experience. Here's how it could work. First, the AI analyzes the user's body type. This might involve computer vision algorithms, processing a photo or video submitted by the user, or perhaps integrating with advanced smartphone sensors to take precise measurements digitally, similar to technologies being developed by companies like Mirasize. Second, the AI learns the user's style preferences. This could involve analyzing their purchase history, items they've liked or saved, answers to style quizzes, or even, with permission, analyzing their social media profiles or Pinterest boards using natural language processing and image recognition. Third, the AI constantly monitors current fashion trends by analyzing data from runways, fashion publications, social media influencers, and real-time sales data across e-commerce platforms. Combining these three elements, body type, style preference, and trends, the AI curates personalized outfit recommendations specifically for that user. It suggests items that are likely to fit well, match their aesthetic, and align with current styles. The platform would integrate directly with various e-commerce retailers. When a user sees a recommended item they like, they can click through to purchase it from the partner brand. To further enhance the experience and reduce uncertainty, the startup incorporates a virtual try-on feature. Using augmented reality (AR) and the 3D model created from the user's body scan, users can see a realistic simulation of how different garments would look and fit on their own digital avatar. This addresses the major online shopping pain point of not knowing how clothes will actually look in person. Finally, the AI incorporates a strong sustainability focus. It can analyze product data to identify and recommend clothing made from sustainable materials produced by brands with ethical certifications. or items available on second-hand marketplaces integrated into the platform, like those being pioneered by companies such as Reflaunt or Queen of Raw, which focuses on dead stock fabrics. The AI could even provide insights into the environmental impact of different choices, or suggest ways to care for garments to extend their lifespan. Similar to the vision of Save Your Wardrobe, this kind of AI-driven fashion startup represents several key trends we're seeing across industries. Hyper-personalization, the use of computer vision and AI for enhanced digital experiences. Data-driven decision-making and the integration of sustainability concerns. While this specific startup is hypothetical, the technologies it employs are very real and are being developed and deployed by various companies today. It illustrates how AI can create entirely new value propositions and disrupt traditional business models. From an investment perspective, while you might not be able to invest directly in such a startup, unless through venture capital, understanding these applications helps identify the underlying technologies and infrastructure providers that will benefit. For example, this startup would rely heavily on cloud computing like AWS, GCP, for processing power and data storage, powerful AI models, potentially from Google, OpenAI via Microsoft, or others, and possibly chips from NVIDIA or AMD if doing extensive model training or complex simulations. It shows the interconnectedness of the AI ecosystem and how innovation at the application level drives demand for the foundational players. While the potential of AI is immense, investing in AI stocks carries significant risks that investors must carefully consider. First, volatility and valuation. As we've seen, many AI stocks have experienced dramatic price swings. High valuations based on future growth expectations make these stocks susceptible to sharp declines. If growth slows, sentiment shifts, or broader market conditions worsen, the AI sector can be prone to hype cycles. Second, intense competition. The AI space is incredibly competitive, with established tech giants, well-funded startups, and even open-source communities all vying for dominance. Technological advantages can be short-lived, and companies must constantly innovate to stay ahead. The rise of capable in-house AI chips by major cloud providers also poses a competitive threat to dedicated chip makers like NVIDIA and AMD. Third, execution risk and ROI uncertainty. Companies are investing billions in AI, but translating this investment into tangible profits and demonstrating a clear return on investment ROI can be challenging and may take time. There's a risk that the current spending boom on AI infrastructure might outpace the actual monetization opportunities in the near term, leading to potential concerns about excess capacity or slowing capital expenditures. Fourth, regulatory and ethical hurdles. AI development raises complex ethical questions around data privacy, algorithmic bias, job displacement, and potential misuse. Governments worldwide are grappling with how to regulate AI, and future regulations could impact development, deployment, and profitability for AI companies. Antitrust scrutiny also remains a risk for the largest players. Fifth, geopolitical and supply chain risks. The semiconductor supply chain is global and complex, with heavy reliance on manufacturing in regions like Taiwan. Geopolitical tensions, trade restrictions like export controls on advanced chips, tariffs, or natural disasters could disrupt supply chains and impact companies reliant on chip production or global markets. 6. Cybersecurity threats. As AI systems become more integrated into critical infrastructure and handle sensitive data, they become attractive targets for cyber attacks. Security breaches could damage a company's reputation, lead to significant financial losses, and erode trust. Investors need to weigh these risks against the potential rewards. Diversification is crucial, as is taking a long-term perspective, as the AI revolution is likely to unfold over many years. So, if you're convinced about the potential of AI and understand the risks, how can you invest in this theme? There are several approaches. Firstly, you can buy individual stocks of companies, like the ones we've discussed: NVIDIA, Microsoft, Alphabet, AMD, Palantir, and others. This offers the highest potential reward if you pick the right winners, but also carries the highest risk, as individual company performance can vary significantly. Thorough research and due diligence are essential. Secondly, you can invest in exchange-traded funds, ETF, or mutual funds that focus on AI, robotics, technology, or semiconductor themes. These funds hold a basket of stocks, providing instant diversification and reducing the risk associated with any single company failing. Examples include ETFs focused on robotics and AI, cloud computing, or semiconductors. Make sure to examine the specific holdings and expense ratios of any fund before investing. Thirdly, consider broader technology sector funds, since many of the leading AI players are large-cap tech companies. Investing in a general tech ETF will likely give you exposure to many of these names as part of a diversified portfolio. Regardless of the approach, remember that investing in a rapidly evolving sector like AI requires a long-term mindset. There will be ups and downs, hype cycles, and periods of consolidation. Focus on quality companies with strong fundamentals, clear AI strategies, and sustainable competitive advantages. Don't chase short-term gains, and always align your investments with your risk tolerance and overall financial goals. So, to wrap things up, the artificial intelligence revolution is undeniably underway, presenting what could be one of the biggest investment themes of the coming decade. We've analyzed several key players poised to benefit: NVIDIA, the dominant AI chipmaker; Microsoft, integrating AI across its vast software and cloud empire via Azure and Copilot; Alphabet; Google, leveraging decades of AI research, its Gemini models, and custom TPU; AMD, the primary challenger in the AI accelerator space; and Palantir, whose 8 platform is driving significant growth in enterprise AI. We also looked at other important players like Amazon, Meta, C3.ai, and TSMC, and explored how AI is enabling innovative applications like the hypothetical personalized fashion startup, highlighting trends in virtual try-on, personalization, and sustainability. However, we must remember the significant risks involved: high valuations, intense competition, execution challenges, regulatory hurdles, and geopolitical uncertainties. Investing in AI requires careful consideration, thorough research, diversification, and a long-term perspective. The AI landscape will continue to evolve rapidly in 2025 and beyond. New breakthroughs will emerge, new competitors will rise, and the winners and losers may shift. Staying informed and adaptable will be key for investors navigating this exciting and transformative technology. Thank you for watching. We hope this analysis provided valuable insights into the world of AI stocks for 2025. Which AI stocks are on your watch list? Do you think the current leaders will maintain their dominance, or will new players emerge? Let us know your thoughts in the comments below. If you found this video helpful, please give it a thumbs up and subscribe for more content on technology and investing. Remember to do your own research before making any investment decisions. Until next time, stay informed and invest wisely.